In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
Welcome, everybody. Merrill Chandler here, your host of the Get Fundable podcast. I've got a great episode today. Things are really firing up in the note space, right? And the secondary markets, commercial banks, et cetera, wanting to unload properties, default rates on the rise. And we've got the master of notes here, Mr. Scott Carson will be joining us. So when we come back, stay tuned because we are going to knock it out of the park. Notes might very well be the perfect pivot. I'll be back in a second. Welcome back, everybody. Merrill Chandler here, your guide to the fundability universe. And my guest today, Mr. Scott Carson. Scott, we've been in this game together for 10 plus years now.
Yeah, somewhere around that. I think we're coming up on our quinceañera. You know what I mean? We have to go pick out a big ball gown now for 15
it's
years.
It's time
buddy.
to put on the ball gown. So our quinceañera, glad to have you here, Scott. I want my people to know what's happening in notes, what needs to be done, what to watch for. Are there key indicators that because what do they say? If there's blood in the streets, buy, right? So I'd love to be able to, I'd love for you to help them understand when they can use expert advice and expert coaching on how to engage in the note space.
Yeah, so we've been doing this since 2008. And, we went through the last recession, stuff like that. And we started seeing stuff 6 or 12 months ahead of the big downfall and the big short and that kind of stuff. And we've been seeing stuff distressed really since COVID. We saw a $50 billion commercial mortgage market basically go kaboom with all the things going on. And we still see that today with office space being severely distressed across the country. We see that definitely in multifamily being distressed, over encumbered. That's just a complete show, especially here in a Lone Star state where we see actually this month alone, there's $400 million in distressed multifamily going to foreclosure auctions on the first Tuesday next month, if that tells you. And Texas used to be the belle of the ball when it come to multifamily back in the day. But with distress, it's not just on the commercial side. We are also seeing the residential side. And some of those factors, I know that you've probably talked about beforehand, is like the amount of credit card debt that's in default, the auto loan debt rates in default, student loan defaults. Massive, all-time highs. Well, that's like the first cards in that house of cards, or the first dominoes falling because people are not paying everything else. They're trying to keep their mortgage. Well, we're starting to see defaults increase. And I don't care who you voted for. When we found out what the Biden administration was doing with FHA default mortgages and paying those on behalf of people, that made your numbers and default rates look very crooked from the last couple of years and worse. And when you find that out, you realize it was a lot worse than what they were saying. And so that leads to opportunities as banks, lenders, lending institutions have this stuff that's distressed on their books that they need to get off their books. We just did a podcast yesterday and we figured somewhere around 5,000 plus licensed banks across the country, but there's about 19,500 non-bank licensed mortgage originators also creating mortgages and originating this stuff all across the country. And a lot of it, when you start adding and thinking about what they have on their books or what they've originated and that's starting to default, it leads to a lot of opportunity. It all comes down to, you're not going to be sending out like letters and postcards like most real estate investors have done for lead gen.
Right.
You've got to reach out to the banks through LinkedIn or email blasts or dialing for dollars to find this stuff. But the great thing that I've always loved about the note industry is it's not like a one-off note where somebody owner financed a property and people chase those types of deals. Nothing wrong with that. I've just always liked to work smarter, not harder. And develop relationships with banks that are going to send me, 100 to 200, 500 notes.
Right. And then you can sort through and cherry pick your best deals, right?
Exactly.
Run them through your software.
Yeah, exactly. And it just varies across the country too. I mean, Another thing that people have to consider too is that the state foreclosure time frames are different on a state by state basis. I mean, we are the fastest. I mean, Texas always takes the cake. We're the fastest highways, fastest foreclosures in 21 days, and fastest executions. We're dying to foreclose on people. You know what I mean?
And kill them. So
you know, there's a whole new story in the news today about somebody that tried to execute us for the second time. But then you look at like Florida or God's waiting room, which can take you 12 to 18 months to foreclose. And so you have to understand. I mean, I track foreclosures here in Texas, in Harris County, that's Houston, and then also in Bexar County, if you're not from Texas.
Bexar County,
which is San Antonio. And foreclosures have been inching up each month. So those are some opportunities to look for that you can capitalize on. You know, foreclosures, you're going to be bidding against other people, but I like going direct to the banks to get these lists and, like you said, cherry pick and go from there.
Yeah. So give me an idea of some examples. You mentioned Wells Fargo. You come from a commercial banking space years ago before you started buying your own notes, right? You sourced them in from the commercial side, and then all of a sudden said, maybe I'm on the wrong end of this deal.
So yeah, I'm a previous banker with JP Morgan Chase, and we started a mortgage company that was working primarily with investors, and working with a variety of different lenders for investment loans, rehabs and then cash out refis and stuff like that. But yeah, I mean, I did commercial loans. I've did that for years before I got into the note buying space because I saw the opportunity.
Yeah, I bring that up because you're specifically keyed into how the banks think, how the banks are actually evaluating their portfolios, and when they're going to start sloughing things off, right?
Mm-hmm.
So kind of give us what's happening in your awareness of the banking environment and how things are starting. You used the example of Wells Fargo. I can't imagine they're by themselves.
Yeah, so Wells Fargo just took out like a $200 million loan recently, maybe billion. BM doesn't matter, but the fact that they took out a big loan to stay afloat to cover some of their things, a big chunk of that went to covering reserves. And that's usually the first tick on hey, a bank is in trouble.
Yeah.
Banks have to file quarterly reports with the FDIC. There's a company that we use called Bauer Financial that all I got to do is call them up once a quarter, say, hey, send me the most recent report on banks that have 5 or more branches, what we kind of track, right? Those are the ones that are going to be, and it'll tell us how much in default they have, residential, commercial, what percentage of their portfolio is underwater, how much is coming down the pipelines. It's already 30 to 89 days late. And the thing to look at when you start seeing increase in this distress is looking at a bank's reserves.
Right.
Because a bank has to put so much money aside for every non-performing loan. So it takes money out of the coffer that they're allowed to lend on. And we all know banks leverage, every dollar that comes in 15 to 50 times.
Right.
So if they have to put away money to offset a bad loan, it reduces profitability. It also reduces the ability to lend and make new loans and make money on stuff like that. So when you start seeing a bank reserves start going up, that tells you that, A, they're getting more distressed debt. And the more they get to the point where they're at an 8 to 10% default rate, they look to move that stuff off their books. Now, like Wells Fargo, they're not going to sell a one-off residential note. Bank of America is not going to sell a one-off, but they will sell one-off commercial loans, commercial debts. They have different departments. Like Wells Fargo has a whole division called Wells Fargo Multifamily that handles their apartment stuff that we've bought debt from over the years. And so that's the thing to look at. But that's also a lot of other smaller banks, besides B of A, Chase, they call the Evil Five. You know what I mean?
We call them the tier ones. Right?
Yeah, you call them tier one. On the note investing side, I call them the Evil Five because they don't like to play well, with small investors. That's okay, So, but
too
that's
big
the thing
to fail.
Yeah,
they keep getting bailed out. That's why we invest in them, right?
Yeah, exactly. I mean, Bank of America, let's just take this back. People don't know this a little bit, but Bank of America, if you think back to when everything was hitting the fan and the Fed required all these banks to merge at one point, Wachovia got joined up with Countrywide and a few others, and they forced Bank of America to take like $776 billion in TARP funds or whatever back it was.
Right.
And they didn't touch a dollar of that. They didn't lend it. They literally returned it 12 months later. The reason they returned it 12 months later and then they reported record earnings, it's such an interesting story. It's a web. So Countrywide, we all remember them, big mortgage company got in trouble because they were buying all these negative AM mortgages from the likes of like Greenpoint and others out there. is that Countrywide got bought by Bank of America for 20 cents on the dollar. Okay. 20 cents on the dollar is ridiculous. And so they bought this portfolio of loans, right? And Bank of America, they were like, well, we buy this cheap. If we modify them all into 30-year conforming paper, we could probably sell it on Wall Street. Yeah, we turn around and sell this stuff because the paper as it sat was just nobody wanted to touch it.
Right.
So Bank of America sent out a letter campaign to all their borrowers on these crappy loans and said, hey, we'd like to modify your loan. A no-cost modify. We'll put you at 30-year mortgage, no cost to you, 4 or 5% interest rate, and your monthly payment will be this. Well, nobody responded to their mail campaign because nobody wanted to open their mail because they were in default already. You know what I mean?
Right.
6 months later, it was the worst direct mail campaign B of A have ever done before. 6 months later, they said, okay, we're going to change it. We're going to automatically move these people into these loan mods, and they have to alert us not to do it. Which I don't know how that's legal, but they still did it. Okay.
They tried, yeah.
They sent letters out. And I've had people that comment, I didn't know I was in this bad loan. And suddenly I'm in a 5% interest rate, 30-year mortgage. What the hell? And so they did that. And then when they did that and the people started making payments, it became not only better paper, but then once people started making payments on time for 12 months, it went from non-performing to performing paper that they could turn around and sell off at 80 cents of the unpaid balance. And that's how B of A recorded record profits the year after the TARP funds without using a single dime
using TARP funds.
Yeah, exactly. Which, are we
Genius
going to see
move.
something like that again? Who knows? I don't know. I don't think it's going to get as bad, but as it was then. But we're definitely going to we're going to see more distress. We're seeing more stuff happening all across the country. Foreclosures are up, I think, 30% year over year from last year in a lot of cases. And it's just also some of the economic forecasts are not good for parts of the country. Actually, most of the major cities are going to see an equity drop, a valuation drop of 10 to 40%, which is going to eat up a lot of that equity people think they've got sitting on. And
that's the next thing that I wanted to address, comparing what's happening right now to what happened in 2008, right? I want to delve a little deeper there because it feels a little familiar, right? The last run up, remember 2006, 2007, the ninja loans, no income, no job, no assets. And all of a sudden, right now, I'm seeing in the mortgage space, there's cash flow analysis versus full doc. There statement loans. The only criteria was you have to send all 4 pages of the statement, not just the credits and the debits. 12 months, and they'll lend on it. The DSMR, those are literally $1 more than the rent required. Literally said in the formal documentation, $1 more if we will lend on it if you have $1 of profit where your revenues cost more than your mortgage.
So here's another thing. Those are the new liar loans. If you're going to get financed with a DSCR loan, debt service loan, and it's on a 4-plex or less, they don't care about the rent amounts. You could put them whatever you think they're going to be as long as they're in line. Now, if it's a 5 or more, they have to double check the rents. But if it's 4 units or less, they're not double checking the rents. This literally comes from
stated.
It's stated exactly. Because we have guys that reach out to and they want to market on our show. And I'm like, nah, I appreciate that. No problem. But no, I can't. If you're doing that, it reminds you a lot of what took place. Oh, we're just going to state your income.
2007 again. I'm just seeing this, and I'm not opposed to get it while the getting is good, as long as you know that you got to be in a position to exit before the massive fails, right?
Well, and a lot of people are using those for like Airbnbs. And so some of these things out there too. And that's why I think, insurance and other things, storms like what's going on in Florida. Florida Southwest market, like down Cape Coral. The Wall Street Journal just announced it's the worst real estate market in the country because of just the Airbnb apocalypse taking place.
Yeah.
Me, as a real estate investor, as well as a note buyer, I'm like, well, can I buy those notes for as cheap as I did years ago? Probably have to self-insure them for a while till they figure that out. Inland, maybe not right on the waterfront, and pick up debt at 20, 30 cents on the dollar and hold them for a while. And since I'm buying them that cheap, it allows for me to offer below market rents to get them occupied. There's some plays to be made.
Which then drives down all the other rents, but you're in a position to actually profit by it, right? There are some magnificent plays here, literally blood in the streets. When I started seeing, I saw one guy shared some of these loan opportunities. All of a sudden, we couldn't get jack crap for commercial lines of credit on rentals. Popped up everywhere, like literally overnight. They're now going to 90% on rentals, statements of rent, proving the DSREs or
DSCRs. Yeah.
DSCRs.
And most commercial properties or DSCRs, they have to be at 125%.
Exactly.
And
I'm
not the case.
The awesome tragedy. If you're on the right side, you can profit by it. But I teach all of my clients how to run traffic through their accounts that all of a sudden cash flow analysis. I'm like, we win. #awesome. Right. So, because like many real estate investors, they're flipping, or they were flipping. They've got a ton of cash sitting around, but they don't have a ton of and we convert liquid to cash flow. And we're able to get these approvals, right? So I know we don't have a crystal ball, but you've been pretty damn good over years at crystal ballizing. So what do you sense over the parallels between 2007 and what's happening right now? I just bring up all those loans because all of a sudden everybody's throwing money that isn't going to last, or the equities are coming down. Rents are already coming down.
Yeah, that's the biggest thing we see here too on multifamily. Rents are not stabilizing. Rents are coming down. Vacancies going up. So if you're a multifamily guy, you're probably like bricks. You know what I mean? You're like, and that's what happened. So many people overpaid for multifamily stuff, and then the interest rates never came down. Now they've got to refinance into something that's double the interest rate with half the cash flow because of costs.
And the insurance mess that's
exactly
adding to the bottom line.
Exactly. And their whole strategy of refinancing and cashing out in 3 years has hit the fan because the value's not there anymore because cap rates are down and NOIs are down. So
yeah, syndications are taking a bath right now.
I got a buddy in 20 syndications. He's only getting paid on one of them. 19 of them are not paying. And his minimum investment on those is anywhere from 50 to 100 grand each on that stuff.
So how do we protect my listeners?
Protect your listeners. Here's what I would do. I would not be buying anything right now. That's my opinion. Don't buy anything right now.
All right. There's in the mouth of two witnesses, everybody. Mouth of two witnesses. I'm not the only person out here screaming at the top of my lungs. Stop everything.
Yeah, unless you are buying something that's already distressed, and I wouldn't be paying more than 70 cents on the dollar for it right now. That's the only exception to what I do. And what I would also do, especially if you're a fix and flipper, making sure, I know it's harder, right? We get phone calls a day from people on the fix and flip side who can't find deals because they're overpriced, over encumbered. It costs more to rehab it. This is why we get a lot of people on the debt side and would rather rehab the borrower versus rehab the property.
Right.
Is you have to understand the markets. And if you're in an area that's over encumbered or starting to see a decline, look at the MLS, look at the stats out there. I've got a buddy, Nick Gurley, who runs something called a Reventure app. He's on YouTube. He's kind of the doom and gloom guy, talking about different markets out there. But and sometimes he's a little extreme and a little negative. But the biggest thing you can look at is what happens if your market loses 10%. Are you going to still be good? What happens if you lose 20%?
Like we did.
Yep. And in like some places, we lost 30, 40, 50% in parts of the country, like down in Florida. I mean, heck, Florida was vacant for 30% of its properties. So that's what you have to be. Make sure you're buying right. Make sure you've got multiple strategies. If you're just stuck on one strategy, you probably need to get out of it. And I would be getting the heck out of all my Airbnb, my short-term rentals and stuff like that, because that's, besides just the DSCR loans, when people don't have money to pay their mortgages or pay their car payments, they're not going to pay to go on an Airbnb escapade. You know what I mean? I know that some people are converting their short-term stuff to midterm, like, 30 days. Some of the cities are enforcing those laws too. I just had a buddy, a very close personal friend, who lost 40 Airbnbs because the city said, nope, no longer anything under 30 days.
Exactly. Dude, I mean, it's like the hotel lobbies and the city, and untaxed revenues. They make it impossible by putting on. I mean, hotel taxes are like 15% or more, and then Airbnbs had little to nothing because their city councils didn't move fast enough, and now all of a sudden they're like, well, let's make it 20 or 25% for them to support our hotels, and then all of a sudden now we got priced out of the market because of the tax that have to be added.
Mm-hmm. That's so true. Salt Lake's been usually a pretty good market, but let's look at something here. Let's look at my crystal ball. Shall we look at a few markets
Please,
and talk about?
I would love to see this.
Okay, let me pull this up. So this is my crystal ball.
Now I can see it.
So like I have Austin up because I'm in Austin, Texas. Home price forecast. This is basically tells you how strong a market is as far as demand. It goes from like 0 to 100. Well, if you're below 50, you've got a market that's struggling with more inventory. If it's above 50, you've got a hot market. Austin has a 28 score. That means it's too much inventory.
Okay.
We've lost 5% in value over the last year, which is that's normal. Kind of a price correction. We've always been the hottest for a while. Experts say that we're overvalued by 6.3% right now. We're still very affordable kind of compared to some other cities like LA or other things, but here's the price cut they expect to take place in the next 12 to 24 months, a reduction of 36% in value.
Dude.
Okay? That's not good.
That's crazy talk.
And that's scary because we are the fastest foreclosure state. So if you've got equity and you're thinking about selling, it might make sense to sell your property. Forget the interest rate. So many people are married to this 2% interest rate. I can't sell because again, look, if you want to sell and move, now's the time to sell while you still have inventory, where you're not competing with a lot more people trying to sell. And then rent a place for 6 to 12 months till you find a deal.
I've been in a rental since I shed all of my stuff. I thought all this was going to happen sooner. I'm still renting because I literally got rid of all my inventory, waiting to take advantage of something that comes up soon.
Yeah.
It just took 6 years instead of 2.
Yeah, but that's still okay, because you're probably renting cheaper. It used to be, it's actually in 75 of the top 110 markets, it's actually more affordable to rent in that market than buying a home. And Austin is one of those. Salt Lake City is also one. So let's look at Salt Lake City. A little bit better home price forecast of a 31 ranking versus 28. Only saw about a 1.5% year over year appreciation.
Because we have an organic growth here. It's the Silicon Slopes, huge infrastructure. People are building. Again, the Olympics are coming back. I mean, there is some organic growth here that keeps that a little bit inflated.
A little bit inflated. You're overvalued by 25.5% based on economists saying.
Yeah.
A little bit more expensive in your market there. You need almost 6 times your income to afford there. But price cut's going to be at just under 37%, they say.
So it's going to be almost identical. I mean, to the 10th percentile, the same devaluation is coming.
Yeah, exactly. What other markets shall we take a look at? We got 855 cities on here. So
damn.
Let's do this. Actually, let's just do this, and we'll re-rank it by the largest populations. How's that sound?
Okay.
And
I was going to go, what's the largest, sort by the largest decline.
We could do that too, but it's going to give you like some small cities, like 15,000 people.
Oh, got it.
You know what I mean? So let's just do, let's custom sort it by the actual population, and that'll give you those out there. So we'll do largest to smallest. Okay. So now here we go. So you see New York City, boom. They're a little bit higher because it is always hard to find real estate there in New York City. So that's why they're at a 55 versus 28. 4.5% appreciation, overvalued by 6%. It's expensive 7 times your income. Price cut's only going to be about 11% because of, lack of real estate. You got to go vertical, nothing going out. LA, 41, not much appreciation, overvalued by 15%. That's a 21% cut rate, they say. Which that's happening. I think it's also happening too because you've had not only what's going on over there with the crime, the homelessness, and you really see a lot of people selling anything over 5 million, get the hell out of Dodge because that McMansion tax that they put in there. So anything over 5 million, you're getting taxed. The Kardashians bought a house in Houston just recently on the ranch
because of that because
exactly. Yeah, moved from the communist state of California to the Texas Republic. Chirac, this surprised me. Chirac's got a 57% on the height home price forecast, which is okay. Not much growth there, 3.6, overvalued by 5%, but they still see it's going to drop about 15.6% over the next 12 to 24 months. Dallas,
But
Texas.
all of these every one of them are double-digit price cuts. I don't see a single 8% or 7%. These are all, and most people get excited, and the new loans coming out go up to 90% LTV. They're like, I can get as much money out of here as I want. And right now you're going to be underwater in the next 12 to 24.
If you want to move to Buffalo, I mean, that's the lowest city.
There you go. Yeah.
Buffalo.
It's got a great sauce, I hear.
Yeah, exactly. Rochester, New York. I mean, if you like the frozen tundra up there and you're part of the Bills Mafia, there you go. 9.8% decline in Buffalo, New York, only 5.4%. But that's a whole, I mean, those are some of the most affordable properties out there. 20 grand will buy an old house, but it's Rochester. You're going to freeze your ass off half the year anyway.
Exactly.
With
no new industry or anything supported, you got to be on pensions to live there.
Yeah, exactly. Pretty much. Or, Syracuse, New York at 8.7. So, you buy New York, it's going to take you 2 to 3 years to foreclose if you wanted to, which is, hey, live for free for 3 years,
Dude, that's money, right? You're welcome, community. You're welcome. This is what I'm talking about. Why we're bringing Scott in, because he's got intel on likely your very city.
Yeah, exactly. What I'll do is I'll shoot you the list as well, Merrill, you take a look at it. If anyone wants to download this or get this, they can reach out to you.
Can we put it in the show notes?
Of course, go right ahead.
Yep. All right, Sky, let's add this to the show notes.
But it's just this, when you see stuff like this, like, okay, where's the opportunity? Like, that's what you have to look at. Yes, this is scary, but that means those that have the biggest declines, especially if they're in an area that's desirable, like Florida, people want to come back to that. So we used to, I'll give you an example. Back in 2000, we were buying condos on A1A, Miami Beach for like 5 to 10 grand a pop. Okay, they were way underwater, way over encumbered and stuff. And we bought them knowing that it was going to take us 18 months to 2 years to foreclose. But we were buying them at 5 grand, knowing that they would rebound probably in that time. And they did. I mean, I have one condo right now. It was on Palm Bay. It was so pimp. I mean, 2 bedroom, 2 bath, 1,000 square foot as a bachelor at the time. It came with a boat dock, down there for my double twin outboard.
Nice.
You literally, like, 180-degree view of the water. It was literally, you look down and there's the hot tub in the pool 8 floors down below you. I was bitching about that. It was valued at 105 back at the time, and I was going to have to pay 75 for it. I was like, well, that's 72% of value. I don't want to go above 70. Well, that thing's worth $555,000 right now. The guy owed 300 at the time. It dropped. I could picked it up for like less than 30 cents of what was owed. And I started getting grouchy. Now I look back and I get grouchy now just thinking about it.
Yeah,
rents are $500 a night, on the low stats. I could have lived there half the year, and then the other half of the year rented it out and then paid my mortgage and then some.
Paid and then capitalized. Yeah. All right. So, what top 2, 3, 5 things are you going to recommend to my people? Because I don't know, half our listeners are even your people. So, right. So, what do you want? What would you tell my people to watch for, be prepared for, or capitalize? Right.
So here's what I would do. I would be reaching out to anybody out there. First thing I would do is go to your local real estate club. That's a great way to network with people locally that can help you out. That's check done. Go there and find you a good realtor who's been through this, been around for 15 years. Not somebody that's been around for the last 4 or 5 who couldn't market themselves out of a paper bag. Those folks are probably bagging groceries at your food saver anyway.
Right.
Because they've just seen the market. What is this
I
stuff?
love you so much, Scott. Geez. It's the mortgage brokers who get in and ride a wave, and then they're the first ones out of the business because they don't have any staying power.
They don't know how to develop. Exactly. So your Betty Blue Hairs might be the good ones, as no offense to this season. But so, and then start looking at your foreclosure list. You could go to foreclosure.com and start tracking foreclosures in your market. In Texas, we use the Roddy list.
Foreclosure.com.
Yeah, or FLS online. Or Roddy.com. Here in Texas, they track all 220 some odd counties and start looking at stuff. Now, there are opportunities in 2 cases. A, not only buy distressed debt, you could do that by tracking some of these and seeing which banks have stuff they can reach out to, or targeting people that are facing foreclosure.
They're pre-foreclosure, but they're threatened.
Exactly. Now, the thing is that most of these foreclosure lists will give you the details of the mortgage and what they owe and what their interest rate is. So there are folks out there that have 2%, 3% interest rates that are losing their house.
Yeah.
That you could technically step in, take over their mortgage payments on a subject to deal, and still have equity, maybe a little negative equity, but you maybe got to pay 3 to 6 months of payments to somebody, but you still kind of acquire that property and ride it through the downturn a lot of stuff, because you got a low interest rate. That low interest rate gives you the flexibility to carry it, whereas for somebody who can't, they've got to step away. Right. And it's not, they're not going to be able to go buy a new house for 24 to 36 months once they're more than 2 months late anyway.
Right.
So it gives you the opportunity to hold that. Looking at distressed debt, there's plenty of opportunities. You want to put dry powder aside. So you've got some networking with self-directed IRA companies are always a good thing to do as well, because there's other investors out there that might sit on the sidelines that don't know where to put it.
Well, that's plenty. He's giving it away, guys. He's giving it away. I've known Scott, like you said, it's likely our quinceañera year.
Yep.
We've been doing this forever together, and he has an amazing program. Tell us how they can. You just gave away the farm in all those suggestions. How can they optimize their time and energy by leveraging knowing you?
Yeah, so we have a couple different classes that we teach online. If you're interested in seeing if note investing is the right thing for you, you can always go to noteweekend.com. That's our class we teach once a month. It's a free class for like 3.5 hours on a Saturday. You can always go and watch the replay when you want to. But noteweekend.com, and then we have our true nuts and bolts 3-day workshop online via Zoom called Note Buying for Dummies. And that's the actually the number one investor recommended class if you're a note investor out there. Recommended by people a lot older than me who've been around a lot longer time. Okay, it's not one of these self things, but we show you how to find these deals. We show you how to fund these deals. We show you how to flip these strategies, and then how to market them all, and how to go direct to banks, not having to spend thousands of dollars on direct mail, but how to literally have banks sending you these lists of deals into your inbox on a daily, monthly, or weekly basis.
Excellent. Thank you so much, Scott, for being here. I'm finally feeling validated for liquidating all of my assets back in 2000, knowing that this was coming, and I really feel it now. I feel it in the banks. I feel it in the markets, and what you just shared with us, which, by the way, will be in the show notes, guys. That list, that was gold, bro. Thank you for all of this, man.
Not a problem, buddy. Always good. That's the thing, is knowledge is king, and what you don't know, you don't know. And I've got that from somebody that's smarter than me. So, hey, make the best and leverage your audience to find things out, because you got to know. Everything's not always rosy. And finally, I think realtors are finally getting around. Well, it's maybe not so rosy anymore.
Yeah.
People, if you can be 6 to 12 months ahead of what most people are saying, like you said, when there's blood in the streets, don't run away from it, run towards it, and you'll find the opportunities.
That's me, man. Lean in.
Yep.
Everybody, thank you for joining us, Scott. This is Merrill Chandler, your guide to the Get Fundable universe. More importantly, your guide to connecting with a genius who can help you take advantage of the blood in the streets. You guys have a fantastic, absolutely fantastic day, and we will see you on our next episode. Thank you, guys. Thank you, Scott.
You're welcome. Thank you.
Thank you for listening to the Get Fundable podcast. Please leave comments, because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you got to tell your friends about this podcast, because we want them to get fundable too.
Hey, real estate investors. So you want to dive into the world of note investing, but don't currently have the funds to sign up for an expensive class or a workshop or one-on-one coaching. Well, then you definitely want to check out the biggest bang for your buck in the note world, and that's our WCN membership. It get you an all-you-can-learn access to our class workshop replays, tapes, weekly coaching calls. For $97 a month, it's the biggest bang of the note industry, because you get access weekly with me. You can book one-on-one phone calls with me. As we get different tapes in, we'll share them with our members after our one-on-one coaching students get access to us. We share a variety of tools, like I said, replays to the previous workshop, special discount codes to other events that you can take advantage of to help you get more bang out of your dollar every month. We've been investing in notes for over 20 years, and one of my biggest passions is helping note investors, big and small, get started buying notes. Yes, I got started years ago with no money, no savings, and no list. And I love helping people close on their first deal, get their first private funding partner to help them fund more deals and help them both make above average returns. If you're looking for somebody to help you take your note investing from 0 to 60 and want to get started, my WCN membership is a great place to get started. Like I said, we upload lists to it, video training, coaching calls for $97 a month. What can go wrong? The only thing we ask is you hang around for 6 months, and then if you don't like it, you can cancel. But check it out at noteumbrella.com. That's noteumbrella.com. That's our WCN membership. Get looking at assets today. Start putting your fingers on the trigger to pull the trigger on some note deals here before too long. Yes, anybody can buy notes. I don't care your age, your savings, what race, color, whatever it is. Note investing is all about what action you take, and the first action you should take is signing up for our monthly membership at $97 a month. That's noteumbrella.com. You can also access it by going to weclosenotes.com and checking on the monthly membership. But we are here to help you. Scott Carson, the Note Guy. We look forward to seeing you at the top.